Hey everybody, this is Brant from Wolf on Wall Street Trade, and we're going to take a look at the market now that we're almost 2 weeks past the election. You can see the averages kind of risked down a little bit before the election. Came down, most of them came down to their 50-day. This is Tuesday when everybody's voting, and we get the results. Tuesday night they start coming in. I was covering this live for subscribers, and you could just see like right off the bat before right after East Coast polls closed, but before any of the swing states were called, you could see right off the bat Trump trades like Tesla and after hours were flying, or Bitcoin was flying, S&P futures were flying. So it was very early on. I mean, much earlier than I would have thought, going by where they were calling states and how early it was in the process. This is a heads up or a really strong cue to go with Trump before the election. This is 3C on a 7-minute chart of S&P futures. So this is Monday overnight. Okay, the election, everybody voted over here on Tuesday, and election results were coming in overnight over here Tuesday night into Wednesday, right? But look at this big buying. I mean, huge buying on Monday in the overnight session in futures, S&P futures, while the market is pretty much flat. S&P futures are flat, but 3C is soaring. So I'm not sure how to explain that, but it seems like somebody had some maybe inside information or information that wasn't public, and they were betting heavy on it Monday night. Now, the weird thing is that we weren't seeing this in the cash market with 3C. So let me give you an example, a chart here. So this is the election, right? 3C should have soared with prices. It didn't budge. So I have no idea what this is about. I know CTAs, commodity trade advisors, that just move in a herd. They can move 3C really fast because they go all in at certain levels or all out at certain levels, but there was just no confirmation in any of the cash charts. I can show you another one here. IWM, kind of even worse, like a little bump and then just starts coming down into it. Sometimes it'll take 3C 1 day or maybe 2 days at most to catch up, but this is a really fast time frame. It should have pretty much caught up by the next day and just wasn't there. So what I was terming this to subscribers was basically a knee-jerk reaction, and the underlying flows in the cash market were not strong, but in futures they were. So interesting dichotomy. As far as IWM small caps go, there is this indicator I keep that's called the most shorted index. So it's a list index of the most shorted stocks, and small caps almost always move almost in sync with it, but there's like a top range where that short covering just ends and fades, and small caps rally fades. So it hit it right up here on this night. I'll show you real quick. So this is IWM, and the white line is the most shorted index, and you can see how closely they track. So mostly over the last, 2 or 3 years, any strong move in small caps has really been based on short covering, like we saw over here. And this was actually one of the most powerful rallies, one of the most impressive rallies I saw in small caps with excellent volume. And then we had like a little failed breakout from a consolidation here. Failed breakouts lead to fast reversals, but the point is, like, this range here in red of the most shorted index is where these small cap rallies tend to fail, and we just hit that on maybe Wednesday night. Here's the result of that. So this is the top of that range that I just showed you, and just small caps start to come down. The absolute destruction here in the most shorted index, I mean, it's below levels where we get that big election gap up. So again, it just ran out of short covering momentum, and you see the small caps come down this week. Last week, the S&P had its best week in a year, right? And then this week, especially NASDAQ, you see this? I mean, retracing right back into that gap, which is one of the things I was saying to my subscribers based on that 3C chart, is that this just may be a knee-jerk reaction and we fill that gap. We got a little more interesting up here, and we'll go into that in a second. But again, IWM, small caps. Here's the big gap up the day after the election and fading right into filling that gap. So here's a 10-minute chart of the S&P, and it looked like we were getting a little bull flag. It wasn't really well defined because we only had, at that point, one pivot here, one pivot there, and one pivot here. And it started to slip down a little bit below this bull flag line, which was very early. And often, you know, a bull flag will start kind of slim and narrow, and then it will widen out. So we give it a little room for that. But on probabilities alone, when you have a big move up like this and you start to see a consolidation, you have to give it the benefit of the doubt and say it's a bullish flag. But there wasn't consistency in each of the indices. So if we look at the Dow, it was a little sharp to come down from this flag here. Usually that's not how you see flags form, but not a huge deal. It was like, let's see if it plays out a little bit and confirms this trend line again. It slipped down. The NASDAQ 100. Usually bull flags are an exact parallelogram. So on one like this, I would draw the top trend line first and make an exact copy. Watch, I'll just create a parallel trend line and slip that in, because bull flags are almost always symmetrical. The only thing with this one was the downward slant of the parallelogram was very flat. Not a huge deal, but again, on Thursday, we started to see it kind of slip below that. And it's like, well, you can give it a little room to do its thing, and maybe it's going to turn into a little bit wider bull flag. But again, kind of slipping, and then we have the small caps, which were just too steep for a bull flag. It's just not how it should look. It should be kind of like a straight up move and then a flag. And we got kind of a straight up move, kind of like a stumble, and then a flag, and it was very, very steep, and it was starting to break down already in back test as of Thursday. So this is Friday's price action over here. And what you can see with both NASDAQ and IWM is they're filling that gap. So here's the gap over here, and they're filling it with NASDAQ even more so. It's almost filled it completely, pretty close. What changed between Thursday and Friday? Because it may have just gone on as a bull flag had this not occurred. So on Thursday, Powell said that the Fed is in no hurry to cut rates. So December rate hike odds absolutely plunged on Thursday, right? And he also said inflation's on a bumpy path, which is what I've been pointing out. You know, we get these little jots and jiggles in inflation. So it's trending down on a rate of change, year over year rate of change basis. But, you know, when you think about the election and why it was such a blowout. Look, if Trump had won a second term in 2020, he would have inherited inflation and it would have been his problem. The Fed is mainly responsible for that because they took a year to take action on inflation. Inflation's soaring. They're calling it transitory. They have rates at 0% and they're buying assets with QE. So they're absolutely pouring gas on the flames of inflation. I think if Trump had won in 2020, it would have been his problem. Maybe his policies would have been a little different, but it's really the Fed's policies that are at fault. In any case, that created some trouble over here on Friday. So Powell is putting the market on notice that they're probably not going to cut in December. This is because the Fed is leaning more towards dealing with the stable employment or maximum employment of their dual mandate, and they're less worried about the inflation mandate, stable prices. So that's what's happening there. I'm not sure I would take that tact, quite frankly, because the last labor report, jobs report, came in at just 12,000 jobs added. I mean, that is atrocious. And 48,000 of those were government jobs. So if you look at private payrolls, they actually went down. And with something like 7 of the last 9 payrolls revised lower, it's very likely that the last payrolls report will be revised lower from 12K to something negative. So you can see a big, great, solid first week. and a pretty ugly second week. And this is what I was telling subscribers, that I think this is a knee-jerk reaction based on assumptions. We'll go into those assumptions and what they mean, just to be realistic about what we have to look forward to. Like small caps had a huge move the first week. I think they were the best performing of all the indices because everyone is assuming that cyclical sectors and value-based stocks are going to explode higher. So everybody kind of crammed in to IWM or the Russell 2000. But if we end up with a tariff regime that resembles the recent proposals, the basic math would suggest that small caps will face a lot more earnings impingement than large caps or mid caps. Most S&P sectors were down on the week, so the big standouts were energy had about a 1% gain, and the financial sector had about a 1.4% gain, but you can see momentum over here is fading from the first week. The sectors that did the worst, one of the favorites in the first week was industrials. So industrials were down 2.10% on the week. Let me just zoom this in a little bit. So there's industrials. What else was down? Real estate, and I think that's probably a no-brainer with rates as high as they are, and I'll show you them. But that's not real estate. There we go. Real estate. So that was down a little bit over 2%. The materials sector, that was down about 3.4%. That's really a big move. I mean, that's retraced everything from the first week's kind of knee-jerk bounce and a really big move lower. So that's about 3.4%. And the worst were actually technology, the most heavily weighted S&P sector. So it gained 5.9% the first week in that knee-jerk reaction, and this week it lost 3.5%, a little bit more than 3.5%. And the problem I see here is semiconductors are a big problem. Let me show you that. And if you don't see it, it is a head and shoulders top over here, and it's just getting ready to break down. As a matter of fact, let me add the 200-day moving average, and you can see this week we closed below the 200-day moving average. So for subscribers, I put a post out on semiconductors and how to play this semiconductor top. It's actually quite a large top, about 28%, I think. Close to 28%, a downside measure moved once you break below the neckline here. So one of my favorite spots is as the right shoulder pivots down, which looks like we're starting to get right now. That's a decent spot to get a short. Usually price will come down and hang out around this neckline for a day or two, sometimes a little bit more. But a break of the neckline is a good area. Oh, what I do with my trend line. And also, and this is a little bit lower probability, is a break of the neckline and then a back test into it. So basically you get in short at the neckline, right? Which is a good place. But you've already got the knowledge that the neckline has been broken. So you have a higher probability trade. You don't have quite as much profit potential as a pivot down from this right shoulder. And the other thing is, it's probably a 60-40 chance that it backtests that neckline. There's a good chance it just slices right through and never backtests it. So those are my three favorite spots and why, and I kind of elaborated on the levels in that post for semi stocks. And it's not just the price pattern. The volume has to confirm, and the volume has been confirming excellent. So on rallies over here, you see volume falling. On declines, you see volume rising. Rallies, volume falling. Declines, you can see volume rising, which is perfect confirmation for head and shoulders. And if you don't have that, I would never consider just the price pattern alone a head and shoulders. You have to have that volume confirmation. So that's going to be a problem for the tech sector. And actually, it's maybe a problem for the NASDAQ 100 because semis do tend to lead that broader index. This is the NASDAQ 100 in the green and red candles, and the semiconductor index SOX on a relative basis. If you remember, we were in a bear market in 2022, and then we saw huge accumulation of mega caps in December when they were being dumped. Mega caps were the most hated stocks of this bear market, so nobody wanted them. We had big tax loss selling in December, but 3C was going nuts to the upside. So we could see that smart money was accumulating that sell-off. They were buying a big dip in a big way. And that manifested with tech leadership starting in January of 2023. If you look at small caps over here, they have a higher high relative to the NASDAQ's almost equal high. So they are leading even the NASDAQ higher. And if we just kind of go out to where we are currently, what you'll see is that they're now starting, semiconductors are now starting to lead the tech-heavy NASDAQ lower over here. So we have two major divergences between the two. One was here when mega caps and tech came into power and leadership. And one is here where semis are starting to lead them lower. One of the assumed sectors that will not do well under Trump administration is healthcare. And this is the election day or the Wednesday gap up, and then it completely fades it and then just breaks down below the 200 on larger volume. But I will say Robert F. Kennedy has pledged to legalize marijuana and psychedelics. So we have some good looking contender trades long in that space in marijuana and psychedelics. I would advise taking a look at some of those, because if he follows through, and he's very passionate about it, with legalizing marijuana and legalizing psychedelics, there's going to be some big winners, and a couple that we've picked out already are looking great, unlike the healthcare sector. Let's take a look at rates real quick. So this is about the year-long deflationary downtrend. And, the thing about inflation, so the Fed comes out and says inflation is coming down, inflation is trending down. They're not really being honest about it. It's trending down on a year-over-year rate of change basis, but the actual inflation that we've experienced, or that consumers have experienced over the last 3 years, is 22% rising. So if the Fed gets down to its 2% inflation target, which used to be 0% before Ben Bernanke, if they get down to that target, which is basically a tax on you, inflation is still rising. It's just rising at a lower rate of change. So most of the time when incumbents lose elections, like George W. Bush, the first Bush in the late 90s, had an excellent approval rating, but the economy started to go to hell in a handbag. And when that happens, these incumbents get kicked out. So since the Fed cut rates by a big surprise, 50 basis points, which is right here, this small candle, the 10-year yield has risen since the Fed cut over here by 50, 76 basis points up to here. So that encompasses not only the September rate cut, but also the November of 25 basis points. So the Fed has cut rates, yet yields have exploded higher. And I've been telling subscribers, that the longer that this sits above this deflationary trend line, the more fearful investors are going to be. We'll see small caps get hit first, then mid caps, and then large caps the longer it sits up here. And we just saw small caps have a terrible week. The US dollar index over here has been soaring, absolutely soaring. We did get a down candle on Friday. This is after Powell backed off December rate cuts, or sounded like he was backing off them. This is the 7th straight week of rally, and the Bloomberg Dollar Index has hit November 2022 highs. So this has really started to impact commodities, precious metals, stuff like that. But one interesting thing I sussed out, just going through correlations, this is going to be a weird one for you, but it's interesting. Let me just add a study here. I'm going to add Bitcoin to the dollar index chart. And you can see this policy of weak dollar, and you see Bitcoin not react very well when we have weak dollar policy. When we have strong dollar policy like this, you can see Bitcoin is almost tracking it tick for tick. So let me go down to like a little more detailed chart, the 30-minute, and you can see the same thing, you know, in a relative basis. As the dollar moves up, or as the dollar moves up in strong dollar policy, Bitcoin has been tracking that very, very closely. Bitcoin closed above 91,000. 90,000 is the key level to be watching. There's a lot of action going on around 90,000. As for gold, there hasn't been a single time this year that I've been concerned about gold. In the early part of the year, I said I want to see gold consolidate as long as possible, build like a base that we can launch from that supports a strong rally. And that's what we got, a very strong rally. But when we got up into here, this was the first time I had some concerns about gold, right? And gold just saw its worst week since I think it was June 2021. Maybe we have a hammer candle over here. Maybe. So we'll be watching that. This 2600 area, which is this trend line, is really, really key area. So if we look at it like on a shorter term time frame, go to 15 minutes, we could just see, you can see it bouncing around that trend line as support, breaking through it. But it's right around this 2600 level. So I don't know, maybe that hammer is the start of something with a little bit weaker dollar that we saw on Friday. But right now, I think we need to see some stronger price action before getting back involved. This is not a consolidation. This is a full-on correction. You can see the price action is just bearish throughout. That's a little bear flag over here. This may be one too, but we just have to watch the price action and see if it improves here. So for some real world perspective, because right now we're seeing knee jerks, we're seeing assumptions, and you know, they make sense. Financials should benefit from deregulation and more M&A activity. In theory, cyclicals like materials, industrials, financials, energy should perform better under a Trump presidency than the growth style factors, which are basically large cap tech. But the prevailing economic and liquidity and price trends will ultimately determine which way the market goes, what the winners and losers are with this new president in his second term. It's not just politics. So we know where we are in the cycle. This is the effective Fed funds rate. If you've seen my videos before, you know the trend is to hike rates. The 2-year yield crosses below the Fed funds rate, then the Fed pauses rate hikes, and then they cut into a recession, which is shaded here in gray. You can see the end of the pause over here, the cut into the recession. Even with COVID, you know, we had the hike, the pause, and then cut into a recession. This has been a pretty extreme hike, a very notable pause, and now just starting to cut. So in the cycle, we are late stage, and there's another way we can look at this. This is the 2s, 10s yield curve. I think it's been right just about on every recession except, or at least back to like 1950. So the curve inverts below this black line, and then it sharpens steeply. The reason it sharpens steeply is the Fed is cutting rates right into a recession. Again, it inverts, sharpens steeply right into a recession. Even COVID, it inverted, sharpened into a recession. We had the biggest inversion in 4 decades, which is now starting to sharpen. Why? Because the Fed is cutting rates. So in the economic cycle, you know, whether you're a believer in soft landing, no landing, or recession, there's no doubt we're at the end of the economic cycle. So however it plays out from now, who knows? The probabilities, though, are recession. So I'm just saying we are late in the economic cycle, not early. And the other thing I talked about is liquidity. So if we look at the Bloomberg United States exchange market capitalization here in green, the stock market capitalization, and then we look at the U.S. reserve balance with the Federal Reserve. So banks are just eating up the liquidity here. They're drawing it down from the Fed's reverse repo facility. And at that pace, you just have to wonder if probabilities say, again, that these two converge, which would mean lower stocks. Those are the major factors: where you are in the cycle, where you are in the trend, and liquidity. So far in this last week, what we've been seeing is knee-jerk reactions, and they're reasonable. The market's making assumptions about what's going to do well, what's not going to do well. Healthcare is not going to do well in the market's opinion. Financials are going to do great in the market's opinion. Industrials, energy, cyclicals, any cyclical sector basically is going to do great. And we can even see that with what's happening now. So in yellow, I have my cyclical index. So this is an equal weighted index of the cyclical sectors. And then I have my defensive sectors. Both of these tried to rotate in July when tech got hit hard. Tech was coming down really sharply, and we saw rotation into small caps, into defensives. The small cap rotation failed. The defensive rotation stuck until rates started rising, that big 70-something basis point rise after the Fed's cut right over here. So they're coming down because they're rate sensitive. But since the election, you could see cyclicals have made a huge move up and defensives have made a pretty significant move lower. I'll give you a closer look. And here's the election. So you can see defensives not doing well. Cyclicals just spike higher. So that is what the market's assuming based on who won the presidency, what the policies will be, etc. But in a presidential term, there's many unknowns. So for instance, like a large across-the-board tariff by the U.S. would likely knock global growth lower, which would include the U.S. And we've already seen that Trump has threatened up to 60% tariffs. Whether, he does that or not, who knows? That's an unknown. And from what we know of his first term with tariffs is that they're passed on largely to the consumer. So it's not actually the producer who's being tariffed getting hurt, it's the consumer with higher prices, and then you got supply chain disruptions. Let's go with some historical fact for a second. So under Bush, the first Bush administration, George W. Bush, second Bush administration, he's an oil guy from Texas, right? So the energy sector was expected to outperform in a big, big way. But what actually happened? The energy sector underperformed the benchmark index in the first year and over the full term of his presidency. So did financials. The second term wasn't much better, with banks getting eviscerated after the great financial crisis. So that's one of the unknown unknowns in a presidency. Under Obama's presidency, he was supposed to be good for healthcare as he brought in the Affordable Health Care Act, right? Utilities were expected to benefit from a focus on renewable energy and tech from digital infrastructure. So we had all these assumptions about what would happen with Obama's presidency, yet all these sectors underperformed over the first year and the full term of his presidency, apart from tech, which managed to eke out a small gain of outperformance over the first 4 years. When Biden was elected in 2020, the energy sector was expected to suffer, of course, right? Given the path to renewable energy, ESG, and the discouragement of fracking. But as it happened, the Ukraine war boosted oil, and it became the best performing major asset of Biden's term. That was also aided by restraints on U.S. production, right? So the energy sector went on to become the top performer under Biden's watch. I mean, it makes no sense, right? We have these assumptions of what's going to happen, and over the term, they don't pan out so well. Healthcare was also expected to do well, but it ended up being the second worst underperformer of the 11 sectors. Under Trump's first term, with his America First policies, we were expected to benefit smaller, more value-oriented cyclical stocks. And if we look at what's happening ahead of his presidency with defensive and cyclicals, investors are warming up to that. They're getting positioned for that. In any case, under Trump's full first term in 2016 presidency, growth was the best performing, not cyclicals, not value. Value, which is kind of almost synonymous with cyclicals, was actually the worst performing of his presidency. So what was expected to be first was last. My point is, right now, what we are seeing is positioning for what makes sense under this presidency. And it's easy to see why it makes sense, but over the full term of a presidency, it's those unknowns. As Mike Tyson famously said, everyone has a fight plan until they get punched in the face. Going into next week, what we're going to be watching is whether or not we get, a big reversal and a gap fill, or whether we get a small bear flag in here. If we get a small bear flag in here, we'll have a measured move and we'll know where our downside target is. So I think it's worth taking the first couple of days of next week and just letting price action kind of develop and show itself, show where it wants to go. And there is a chance of that kind of bear flag. If we look on some 3C charts, we could see some money flowing in right over here at the end of Friday. Here we can see it in the SPY. So this is kind of the biggest move really in 3C of all of this post-election. So we see that coming. But that's also consistent with what you see before something like a bear flag, or if we look at QQQ, we saw virtually no confirmation on this big move up, but look what we're getting over here. We're getting a little bit of a positive divergence into Friday afternoon. Again, at this stage, these are consistent with what you would see going into a transition from a down move into a consolidation like a bear flag. So I think it's worth giving the market a day or two into next week and just seeing what price action kind of does. Since we were so oversold on Friday, I suspect we get a little bounce, but is it a bounce to fill this gap, or is it just a little bear flag over here? So that's what we're going to be looking for. And all of this is just kind of knee-jerk reactions to what people think should do well. But as I just laid out for you, what people think and then what the unknowns of a presidency are often very, very different. So we will see. And that will do it for this one. So if you liked the video, I would appreciate you giving it a thumbs up. And if you'd like to see more, please subscribe to notifications for new videos coming out. And you can always check out the website, wolfonwallstreettrade.com, and our new site, thetechnicaltake.net. Enjoy the rest of your weekend.